Dividend investing represents a powerful approach to building passive income through ownership in profitable companies that share their earnings with shareholders. This time-tested strategy has roots dating back to the Dutch East India Company in 1602 and continues to evolve in modern markets, offering investors a way to generate regular income streams while building long-term wealth. At its core, dividend investing involves purchasing shares in companies that regularly distribute profits to shareholders. These distributions provide real cash flow that investors can spend, reinvest, or save. With traditional savings accounts offering minimal returns and inflation-eroding purchasing power at 3 to 4% annually, dividend investing presents an attractive alternative, with many established companies offering yields between 3 to 6% or higher. This approach transforms the traditional time-for-money equation, allowing investors to earn income through business ownership rather than active work. The mechanics of dividend investing center on several key concepts. The dividend yield, calculated by dividing annual dividend payments by stock price, represents your effective rental income from stock ownership. For example, if a company pays $4 per share annually and trades at $100, the yield is 4%. Different types of dividends exist, including cash dividends, most common, stock dividends, additional shares, and special one-time dividends. Understanding ex-dividend dates is crucial. Investors must purchase shares before this date to receive the next dividend payment. Particularly noteworthy are the dividend aristocrats and dividend kings, companies with exceptional dividend payment track records. Aristocrats have increased dividends for 25-plus consecutive years, while kings have done so for 50-plus years. These companies represent stability and reliability in dividend payments, making them cornerstone holdings for many income-focused portfolios. The historical context provides valuable perspective. Benjamin Graham, known as the father of value investing, emphasized dividends as key indicators of financial health. His student Warren Buffett continues this tradition, with Berkshire Hathaway maintaining significant positions in dividend-paying stocks. The Great Depression demonstrated the importance of dividend sustainability over size, as companies maintaining payments earned lasting investor loyalty. This period taught valuable lessons about focusing on companies with strong cash flows and conservative management. Different approaches to dividend investing suit various investor needs. The income-first approach prioritizes current yield through investments in REITs, utilities, and telecommunications companies. The growth and income balance strategy seeks moderate yields, 2 to 4%, with strong dividend growth potential, exemplified by companies like Microsoft, Apple, and Johnson & Johnson. The dividend growth focus accepts lower current yields in exchange for rapid payment increases over time. International dividend investing adds another dimension, as European companies often maintain higher payout ratios than their American counterparts. Building a practical dividend portfolio involves several strategic considerations. The 80-20 rule suggests allocating 80% to established, low-risk dividend payers and 20% to higher-yield, growth-oriented positions. Dollar-cost averaging helps reduce timing risk by investing fixed amounts regularly. For beginners, dividend ETFs like VYM, DVY, and NOBL offer diversified exposure to dividend-paying companies. These funds provide instant diversification and professional management, making them excellent starting points for new investors. Creating a dividend calendar helps spread income throughout the year. Some companies pay monthly, particularly REITs, while most pay quarterly. Reinvestment strategies can include automatic dividend reinvestment plans, DRIPs, during accumulation phases, or manual reinvestment for greater control. This systematic approach ensures regular income flow and compounds returns over time. Real-world application makes the concept tangible. Consider owning shares in Starbucks. You become a partial owner of every location, earning a share of profits from countless daily transactions. A starter portfolio might allocate $40 to a dividend ETF, $30 to a utility stock, and $30 to a consumer staple, providing sector diversification and different dividend approaches. For retirement planning, a 4% yield on a $1 million portfolio could generate $40,000 in annual income. Tax considerations play an important role. Qualified dividends receive preferential tax treatment at capital gains rates, 0%, 15%, or 20%. Holding dividend stocks in tax-advantaged accounts like 401ks or IRAs can optimize tax efficiency. International dividends may qualify for foreign tax credits, adding another layer of tax planning opportunity. Common concerns include yield chasing and performance comparisons with growth stocks. High yields can signal unsustainable payments. Checking payout ratios, typically sustainable at 50 to 70% of earnings, helps identify risk. While growth stocks may outperform in certain periods, dividend stocks often provide better risk-adjusted returns and lower volatility. During market crashes, quality dividend stocks typically demonstrate greater stability due to their strong cash flows and established business models. The power of dividend investing lies in its compound growth potential. Regular dividend payments reinvested over time can significantly accelerate wealth building. Starting small with consistent investments allows time and compounding to work their magic. As Peter Lynch advised, know what you own and know why you own it. Understanding the businesses behind dividend payments remains crucial for long-term success. This strategy offers both simplicity for beginners and complexity for advanced investors. Success requires consistency, patience, and careful selection of quality businesses. Whether starting with $100 or managing a substantial portfolio, dividend investing provides a proven path toward financial independence through ownership in profitable enterprises that share their success with shareholders. The psychological benefits of dividend investing shouldn't be overlooked. Regular dividend payments provide tangible reinforcement of investment decisions, making it easier to maintain long-term perspective during market volatility. This steady income stream can help investors avoid emotional decisions and stay committed to their investment strategy, particularly during market downturns when dividends continue flowing despite price fluctuations.